Picture this. You're 29 years old, you have a degree, a job, a budget spreadsheet you actually use, and you still feel like you're losing. Not slowly losing, losing fast, in real time, while watching someone your exact age close on a house in Nashville on Instagram. And the worst part? You can't figure out what you did wrong. Here's the thing. You didn't do anything wrong. The economy did something to you. Twice. And there's a very specific reason Zillennials, the microgeneration born roughly between 1991 and 1999, keep feeling like they're running a race where someone quietly moved the finish line while they were mid-stride. This video is about that. 10 concrete, research-backed reasons why Zillennials feel financially left behind in America right now. And I want to be upfront about one thing before we get into it. Most of these aren't things you'll hear in a "just stop buying avocado toast" article. These are structural. These are documented. And one of them, the last one, is probably the most invisible problem of all, and the one that actually explains why the other 9 keep happening without anyone fixing them. Let's start with the one that set the whole thing in motion. Most people talk about millennials and the 2008 financial crisis like it's their story. And it is. They graduated into it, they felt it in their first jobs and their first apartments. But here's what almost nobody talks about. Zillennials didn't graduate into 2008. They were 10 to 15 years old, sitting at the kitchen table, watching their parents panic. Economists actually have a name for this: the scarring effect. The idea is that watching a recession during your most formative years permanently shapes how you think about money, risk, and security. Not just for a few years, permanently. So imagine being old enough to understand that the house is on fire, but too young to reach the fire extinguisher. That's 2008 for a Zillennial. And then, just as the oldest ones had barely gotten a career foothold, maybe 2 or 3 years into their first real job, COVID hit. They didn't get the full millennial experience of graduating into a recession. They didn't get the full Gen Z experience of growing up entirely digital native. They sat right in the middle, which sounds like luck, until you realize it means they fully understood both catastrophes while being too young and too early career to protect themselves from either one. Meet Tyler. Tyler's 28, works in marketing in Columbus, Ohio, makes decent money, and has been almost ready to buy a house for 3 years. He remembers being 13 and watching his dad sit at the kitchen table with a stack of bank letters. He doesn't talk about it much, but he also hasn't been able to make himself put money somewhere he can't immediately access it, because somewhere in the back of his brain, a 13-year-old version of him is still watching those letters. Then COVID hit when Tyler was 22, just starting out. 2 economic catastrophes, 2 developmental windows, 0 fire extinguishers. That's the Zillennial origin story. Now here's where it gets interesting, because Tyler isn't just dealing with trauma. He's also following rules that were never designed for his reality. And this next one is going to make you genuinely annoyed. You've heard it 1,000 times. Don't spend more than 30% of your income on rent. Your parents said it, every personal finance article says it, your landlord probably said it while handing you a lease that already violated it. Here's what almost nobody mentions. That rule traces back to a government housing amendment from 1969, and Congress bumped it to 30% in 1981, essentially for budgeting convenience. It was never based on what actually constitutes a comfortable life. It was a policy number, picked in a room, in a different economy, in a different America. The number of cost-burdened renter households hit a record high in 2024 at 22.7 million. That's 49% of all renters. From 2001 to 2024, renter incomes rose by 9% in real terms, while rents rose by 30%. And here's the kicker. The share of cost-burdened renters rose most rapidly among middle-income households, with the share of burdened renters earning $45,000 to $74,999, growing by a substantial 2.1 percentage points from 2023 to 2024, and up an incredible 9.5 percentage points since 2019. So we're not talking about people who are broke. We're talking about people with decent jobs, following a rule written in 1981, in an economy that has completely outpaced it. Back to Tyler. Tyler makes $58,000 a year. His rent is $1,450 a month. That's 30% of his take-home. Technically, he's following the rule. He's also not saving anything. He's not doing anything wrong by the rule's own standards. The rule just doesn't work anymore, and nobody officially told him that. His parents told him the 30% rule, so Tyler's following bad rules in a bad market. But here's the part that makes it feel so much worse on a daily basis, and this is the one I want you to sit with for a second. Psychologists have a concept called relative deprivation. You don't feel poor in a vacuum. You feel poor compared to someone. And Zillennials are the first generation whose comparison group isn't the neighbors on their street. It's their entire Instagram feed, curated daily, served to them in their pocket. Research confirms that visual wealth exposure on social media significantly increases feelings of relative deprivation through upward social comparison. So when Tyler sees someone his exact age buying a house in Austin at 27, his brain doesn't go, good for them. It goes, what am I doing wrong? And unlike older generations who compared themselves to the Joneses next door, who were at least subject to the same zip code economy, Zillennials are comparing themselves to the most financially successful people from an entire generation, every day. It's like playing a rigged game of whose bank account is it anyway, and the show never ends. Tyler's scrolling at 11 p.m. He sees a guy from his high school, same year, same city, posting about closing on a house. He double taps it. He puts his phone down. He opens his banking app. He closes his banking app. He goes to sleep feeling vaguely like a failure, even though he did nothing wrong today. That's not weakness. That's a documented psychological response to a media environment that didn't exist for any generation before his. Now, I mentioned at the start that there's one thing almost nobody is talking about that actually explains why all of this keeps happening without getting fixed. I'll get to that. But first, let's talk about something the federal government accidentally did to an entire generation's sense of financial reality. Between March 2020 and October 2023, the federal government paused student loan payments and froze interest. For Zillennials carrying tens of thousands in debt, this felt like actual breathing room. Some saved, some traveled, some just paid their rent without doing math 3 times first. The problem is that pause quietly rewired their sense of what they could afford. During the forbearance period, the share of borrowers with flat or growing balances spiked dramatically. Then, payments resumed, interest kicked back in, and millions of Zillennials suddenly had to find $300 to $500 a month they'd gotten used to not spending. The average monthly student loan repayment in 2025 is over $530, which is roughly 41% higher than the inflation-adjusted 2005 repayment amount. It wasn't just a financial hit, it was a psychological one. They'd started building a life on a floor that turned out to be a rug, and the rug got pulled. Slowly, with a lot of government emails they definitely read. Tyler again. During the pause, Tyler finally felt like he was getting ahead. He paid off his credit card. He started a savings account. He booked a trip to Portugal he'd been putting off for 4 years. He felt, for the first time in his adult life, like maybe this was manageable. Then the emails came. Then the payments came. Then the savings account went back to zero. He didn't make a single bad decision during those 3 years. The floor just moved. Here's something that connects directly to that. When your brain decides the future is uncontrollable, it stops delaying gratification. There's actual science behind this. It's called doom spending, making impulsive purchases to ease feelings of anxiety and hopelessness. And it's not just a TikTok buzzword. The psychology is well documented. When people perceive the future as uncontrollable, they stop saving for things they don't believe they'll get. Why put money into a down payment fund for a house you statistically can't afford when you could have a really good dinner tonight? Tyler knows he should be saving. He's saved the budget templates. He's watched the YouTube videos. He also bought a $280 jacket last Thursday at 1 a.m. because he'd had a bad week and the jacket was there. He doesn't feel great about it, but he also can't fully explain why he did it except that the week was hard and the jacket was tangible and the down payment goal felt like a fantasy. That's not irresponsibility. That's a documented coping mechanism for existential economic anxiety. The brain goes, I cannot fix the housing market, but I can have this jacket. Relatable? Yes. Ideal? No. And while Tyler's brain is managing anxiety with impulse purchases, the grocery store is quietly doing something to his wallet that his brain is literally designed not to notice. Shrinkflation. Tostitos shrunk from 18 ounces to 15.5. Gatorade went from 32-ounce bottles to 28-ounce bottles at the same price. That's a significant per-ounce price hike on the same drink. Folgers cut its can. Bounty dropped sheets per roll. The package looks the same. The price looks the same. The product is less. Research on this phenomenon shows that behavioral economists call it the money illusion. People anchor to price tags, not package sizes. So a candy bar that lost 10% of its weight barely registers, but raising the price by 26 cents causes full Twitter outrage. Companies know this. They've been quietly charging a hidden tax on the way to the chip aisle, and the chip aisle isn't even full anymore. Tyler buys the same groceries he always buys. He spends roughly the same amount. He somehow has less food. He's not imagining it. He's not bad at math. He's just experiencing a system that was specifically designed to be invisible to the human brain. He's getting less for the same money, and his brain is wired to not notice. That's not a personal failure. That's a feature of the market, not a bug. Now here's the one that might hit the hardest. And this is the one I want you to think about in terms of where you thought you'd be right now versus where you actually are. Buying a house used to be something people did in their late 20s. That was the timeline. That was the plan. According to the National Association of Realtors' 2025 Profile of Homebuyers and Sellers, the share of first-time homebuyers dropped to a record low of 21%, while the typical age of first-time buyers climbed to an all-time high of 40 years. The historically low share of first-time buyers underscores the real-world consequences of a housing market starved for affordable inventory, said NAR's deputy chief economist. The share of first-time buyers in the market has contracted by 50% since 2007. Median single-family home prices rose by 48% between 2019 and 2024, according to Harvard University's Joint Center for Housing Studies, while median income rose by only 22%. On average, home prices increased more than 50% from the beginning of this decade to the start of 2025. For Zillennials, who are right now in their late 20s and early 30s, the exact age when the old timeline said they should be buying, they're instead competing against cash buyers, facing home prices that have skyrocketed with mortgage rates that doubled from pandemic lows. The American dream didn't move the goalposts. It picked up the goalposts, drove them to a suburb they can't afford, and put them behind a gate. Tyler and his girlfriend have been talking about buying a house for 2 years. They've looked at listings in 4 different cities. They've done the math on down payments. They've had the maybe we should move somewhere cheaper conversation approximately 11 times. Last month, they went to an open house in a neighborhood they actually liked. The house was listed at $389,000. It went for $27,000 over asking, cash, in 4 days. Tyler's girlfriend cried on the drive home. Not because they're irresponsible, not because they didn't try, but because the timeline they were handed doesn't match the market they're actually living in. And here's the thing that makes all of that feel even more surreal. Because while Tyler's trying to figure out the housing market, he's also quietly bleeding money somewhere he's barely paying attention to. The average American thinks they spend around $86 a month on subscriptions. When those same people are asked to actually list them out, the real number comes out to $219 a month. That's a $133 gap. Over $1,500 a year, disappearing in $9.99 increments, each one too small to feel like a real expense. And the average consumer in 2024 was juggling 12 active subscriptions, including ones they weren't even using. The subscription economy was sold as freedom. Cancel anytime, no commitment, pay as you go. The joke is that canceling requires navigating 3 menus, a retention call, a discount offer, and a password Tyler set in 2019 that he definitely does not remember. So the subscriptions stay. And the $9.99 add up. And Tyler wonders every month why he feels like he should have more money than he does. Tyler has Netflix, Hulu, HBO Max, Spotify, a gym membership he uses twice a month, a meditation app he opened once in February, an audiobook subscription he forgot existed, and a meal kit service he paused but didn't cancel. He's not extravagant. He's just living in the subscription era, where the whole business model is specifically built around the gap between what you think you're spending and what you're actually spending. Now, here's something that ties all of this together in a way that's actually kind of fascinating and a little heartbreaking. Zillennials are notoriously frugal. They watched their parents go through the Great Recession. They saw what happens when the floor disappears. And that created something really specific, a generation of people who are simultaneously terrified of spending and, as we just talked about, feeling hopeless enough to doom spend anyway. Which is possibly the worst psychological combination for building wealth that you could design. They save aggressively and then feel like it's pointless. They research every purchase for 45 minutes and then buy something impulsive at checkout. They know all the right financial advice and still feel behind. This isn't a character flaw. This is what happens when your financial education was watching your parents lose everything, followed by a pandemic, followed by mortgage rates that made homeownership feel like a joke. Financially, Zillennials are basically a person who survived 2 car accidents and is now terrified to drive. But also, Uber is $40. Tyler budgets. He has a spreadsheet. He knows what a Roth IRA is. He knows the difference between a 15-year and a 30-year mortgage. He also has $1,400 in a savings account that he's been trying to grow for 2 years and keeps having to dip into. He's not ignorant. He's not lazy. He's a person whose financial instincts were trained by watching the worst-case scenario play out at home, in real time, during the years when your brain is most impressionable. He's trying to build on a foundation that was shaken twice before he was old enough to pour it. If you're watching this and you're nodding along, drop a comment below and tell me which one of these hit closest to home. Seriously, I read them. And if this is making sense to you, subscribe, because we cover this kind of thing every week. The real numbers behind why things feel the way they feel. Hit the bell so you actually see it when it goes up. And now, the one I promised at the very beginning, the one that explains why all 9 of these problems keep existing without getting fixed. The invisible one. Individuals born in the Millennial and Generation Z cusp years have been identified as a microgeneration, with characteristics of both generations, and the most common name given for these cuspers is Zillennials. By one definition, Zillennials were born between 1991 and 1999 and are now roughly 25 to 34 years old. That's somewhere between 30 and 39 million Americans, depending on who's counting. And almost nobody is officially counting. Pew Research doesn't formally recognize the cohort. Major generational studies lump them in with whichever generation makes the sample size more convenient. They experienced 9/11 and the 2008 financial crisis during their formative years, but they don't get the millennial branding around student debt advocacy, and they don't get the Gen Z fresh start narrative. Policy conversations get shaped around the loudest, most studied groups. Zillennials fall in the crack between 2 very loudly discussed generations, which means their specific economic situation, caught between 2 recessions, priced out of housing at peak earning age, carrying debt from an education that promised more than it delivered, is statistically invisible and politically underrepresented. They're the middle child of American generational economics, and the middle child never gets the good bedroom. Tyler doesn't fit the millennial narrative because he's too young. He doesn't fit the Gen Z narrative because he's too old. When student debt forgiveness gets discussed, the loudest voices are millennials. When housing policy gets discussed for young people, the conversation pivots to Gen Z. Tyler's specific situation, the double recession scarring, the loan pause whiplash, the exact wrong age to be buying a first home, the shrinking bag of chips, doesn't have a political constituency. There's no lobby for the microgeneration that fell between the cracks. And so, the problems compound, quietly, in a generation that's large enough to matter and invisible enough to be ignored. So here's where we actually land. The 30% rule is a fiction from 1981. The housing timeline was real once, and now it isn't. The loan pause gave an entire generation a financial hallucination and then took it away. The subscriptions are bleeding them slowly. The shrinkflation is charging them more for less. The social media feed is making them feel poor in 4K. The doom spending is a documented response to a future that feels uncontrollable. The recession trauma is baked in from childhood. The frugal but hopeless paradox is real and exhausting. And the reason none of it gets fixed is that the generation experiencing all of it doesn't officially exist in the datasets that drive policy. Tyler started this video feeling like he was doing something wrong. I hope by now it's clear he isn't. The rules changed, the market changed, the timeline changed, and nobody sent a memo. If you want to understand why this generation feels the way it does about money, housing, and the future, you just watched it. Share this with someone who needs to hear it. And if you want to go deeper on any one of these, the housing math, the subscription economy, the psychology of doom spending, I've got videos on all of it. Watch one. The algorithm will thank you, and honestly, so will your bank account.